Okay, good morning, or I suppose good afternoon, good evening, everybody, wherever it is that you are in the world. Welcome along to this webinar. It looks like we're still waiting for a few attendees to join us on the session. So what we'll do is we'll get started now and they'll sort of join us as we go. So my name is Jonathan. I'll be your host for today's session. We're going to need around half an hour today, plus any time that we need for questions. And today's webinar is on the very interesting subject of expat pensions. Before we get started, I would like to just ask you that if you have any questions during the session, please write these in the question box that you should see on your screen. It's labeled Q&A. We'll be covering all of these questions in a detailed and dedicated Q&A at the end of today's session. Okay, without further ado, let's kick off. I believe that you should be seeing my screen, so that's okay. We'll start with what I promise you is actually going to be the most boring slide of today's session, so let's just get it out of the way, and that's because it's all about me, but I suppose it is appropriate that I introduce myself before we get stuck into the issue that is pensions. My name's Jonathan. I'm a senior associate here at Holborn Assets. More on Holborn Assets in just a second. I'm a fully qualified and licensed financial advisor to expats in the EU. I've been an expat myself for the best part of a decade now. However, I did qualify in the UK. I'm based on Mallorca in Spain and have been for the best part of 5 years now, but I work with expats all over Europe, helping them to ensure that their finances are planned correctly. And if you'd like to contact me at any point, you can see my email address and mobile number on the screen there. Not to worry, it's on the final slide of today's presentation as well. So if you don't have time to write that down and get in touch after the session, no worries, that will be there at the end as well. Okay, I promised you a quick word on Holborn Assets. Well, here we go. We position ourselves as the financial services group of choice, as we can point to a long track record of putting our clients first. We pride ourselves on exceptional service, or at least what we consider and our clients consider exceptional service, putting the right money in the right place at the right time. Well, what does that mean? Essentially, that means being with you for all the major financial milestones in your life. We specialize in pensions, financial investments, and even property investments for clients in the offshore market. That is to say, our core market are expats, just like yourselves. You may not have heard of us, but we are one of the largest financial advisories in the world, serving over 20,000 clients across more than 100 countries now and managing over $2.5 billion of client assets. Naturally, as a client-centric business, we are regulated in our markets operation. That includes by the Financial Conduct Authority in the UK and in the EU as well, via our European head office, which is in Cyprus. We're multi-award winners, and as you can see, you can see some of the recent awards up on the screen there. And we're extremely proud of our 4.5 out of 5 Trustpilot rating, which puts us firmly at the head of the offshore financial services market. I mentioned that we serve clients in over 100 countries, and you can see our major offices on the right-hand side of the screen there. Of course, as I mentioned, I myself am delivering this webinar to you out of my practice, which is based on Mallorca. So you'll notice it's not yet on that graphic. It's more of a boutique practice at the minute, but I'm hoping to earn a spot on this particular graphic over the coming years. Okay, I mentioned at the top of the session, we'll need around half an hour today, and these are the topics that we'll be looking at. So we'll start with a quick refresh on what types of pension you may have, starting with state pensions, and then moving on to also look at different types of private pensions that exist, notably defined benefit and defined contribution schemes. We'll then look at your options as an expat. So as UK expats, which I'm assuming the majority of you are, you have certain options available to you that aren't available to UK tax residents. A little more on that later, and particularly when we examine the case for an international SIPP or a tax-compliant overseas pension scheme, which is also known as a QROPS. Don't get too worried about the jargon. We'll go into that in a little bit. Here we'll essentially be discussing the ways in which you can transfer your UK pension to Europe and whether or not it might make sense to do so. There are arguments for and against, which we'll dive into. Naturally, for balance, we'll also consider scenarios like I just mentioned, in which it's more beneficial to leave your pensions where they are in the UK. Quick spoiler alert, this isn't usually the case when we deal with defined contribution pensions for expats in the EU, but defined benefit schemes are much less straightforward. So we'll dive into that as well. We'll then look at some additional tax considerations that you should be bearing in mind, particularly after Brexit. And then we'll wrap up with Q&A, as I mentioned at the top of the show. Hopefully this is along the lines of what you're expecting for today's session. So without further ado, let's dive in. Okay, so the first type of pension that should be familiar to everybody here if you are UK nationals, and that is the state pension. Now, if you have made enough national insurance or NI contributions during your working life in the UK, that means a minimum of 10 years if you were born after 1951, you will be entitled to the UK state pension. The more years that you have contributed, up to a maximum of 35 years, then the higher the state pension you will receive. Maximum 35 years, why is that a maximum? That means the full state pension is available to you. It may be possible to make what's known as Class 3 national insurance contributions to make up for any years of shortfall that you might have. As we're expats, a lot of us spend our time moving from country to country, so that can happen. But there are stringent time restrictions in place that limit the amount of Class 3 contributions you can make. The full state pension, however, even if you pay in for those 35 years, is scarcely enough to live on at just £180 per week as of today. And this is why most of us have a private pension, either a workplace scheme or a personal pension, to top up our income in retirement. So for expats such as yourselves, the state pension cannot actually be transferred out of the UK. It can be paid direct into a bank account in the EU, but it can't be transferred out. We'll look at pension transfers in a few moments. This is mainly because it is paid by the UK government from funds available on an ongoing basis. So there is no pot of money sitting around being safeguarded and ring-fenced for your state pension in the future. It's paid on an ongoing basis. However, like I mentioned, as an expat, you can request that your state pension is paid into your EU bank account directly at the then current exchange rate. Not a massive advantage, truth be told, but every little helps. The second main category of pensions are private pensions. These might be with your employer or contracted privately. The differences between workplace and personal schemes are outside of the scope of today's presentation. It would take us far beyond the half an hour that we have allocated. And let's be honest, it's not really relevant as regards what we're looking to achieve today. However, in the interest of clarity, workplace schemes are pensions that are jointly funded by you and your employer, and personal pension schemes are stakeholder pensions, personal pension plans, or self-invested personal pensions, also known as SIPPs. You may hear the term SIPP coming up a little bit later on in this presentation as well. If you're a member of a workplace pension scheme, you will need to identify the type of scheme before moving to the next step. Workplace schemes fall into two very different categories: defined benefit schemes, and these are sometimes referred to as final salary schemes, or defined contribution schemes. And again, these are also known as money purchase schemes. The differences between defined benefit and defined contribution schemes are very important to understand. Defined benefit schemes pay a benefit according to the length of your service with your employer and your salary whilst you were there. And this is either your salary when your employment ended or an average over a certain time period as stipulated by your employer's scheme. Once that pension scheme is in payment, the benefits are paid for life and will usually rise in line with inflation. Defined benefit schemes are becoming quite rare these days, actually, as life expectancies increase. The benefits of these schemes are highly valuable and should only really be given up, for example, in the event of a transfer to European QROPS after careful thought and analysis, because you're sacrificing quite valuable benefits that are guaranteed for the rest of your life. Defined contribution schemes, on the other hand, operate as a pension investment fund. You, and in some cases your employer, make tax-free contributions to a pension fund, which is then invested and grows over time. The benefits you can access depend on the size of the pension fund when you come to access them. Once you've withdrawn all funds, you cannot receive further benefits. Intelligent fund management and access to benefits, therefore, is of utmost importance. The investment strategy should be built in accordance with your individual circumstances, your attitude to risk, and also your capacity for loss. And make sure that you undergo regular performance monitoring and reviews so that your pension is performing in line with expectations and future need. Okay, so what about your options when it comes to accessing your pension? Well, we'll start by looking at defined benefit schemes and then we'll move on to defined contribution. In 2015, the UK government introduced the Pensions Freedoms to provide greater flexibility at the time of accessing your pension benefits and give you greater choice over your payment schedule. However, it must be noted that defined benefits from DB schemes are unaffected by these changes. The only way to access the flexible options provided by the Pensions Freedoms is to actually transfer out of your defined benefit scheme and place the lump sum, this is known as a cash equivalent transfer value or CETV, again, try not to worry about the jargon, into a defined contribution pension. So moving it out of a DB scheme, defined benefit, into a DC defined contribution scheme. Sacrificing the benefits of a defined benefit scheme is an important decision and it cannot be reversed. So advice should always be sought to ensure that it's the right decision for you. In fact, you are no longer legally able to transfer out of a defined benefit scheme if it's worth over £30,000, unless this action has been specifically recommended to you by an independent financial advisor with the requisite pension qualifications. So why would I ever consider a transfer, I hear you ask? Well, hold that thought because we will come on to that in just a second. I mentioned we talk about defined contribution pensions. So these days, most of us hold a defined contribution pension. If you're unsure, it's likely that your pension is a defined contribution. Of course, it might still be a defined benefit, but in most cases it will be. And this is because fewer and fewer employers are offering defined benefit schemes these days. Members of defined contribution schemes and also members of defined benefit schemes that wish to transfer their pension into a defined contribution arrangement have far more options available at their disposal when accessing their pension benefits. These choices can make the decision a little bit overwhelming at times, and what is right for you will ultimately depend on your individual circumstances, again, your attitude to risk and your capacity for loss. The options that you have available to you are, number one, accessing a lump sum, also known as an UF plus, UFPLS, we call it an UF plus. This will essentially entail you paying tax at standard income tax rates on the entirety of that lump sum. It's therefore usually the most expensive option. Option number two is contracting an annuity for regular income. And option number three is placing the pension in what's known as flexible access drawdown and withdrawing an amount of your choosing each month. A fourth option does also exist in the case of UK expats, and that is transferring your pension into a QROPS or an international SIPP. And we will go into that in just a second. That second being now, actually. So on the topic of QROPS and SIPPs, this may be the first time you're hearing these terms. So just to give you the definition quickly, so you're not overwhelmed by all these acronyms that I'm throwing at you. A QROPS is a qualifying recognized overseas pension scheme. These are essentially international pension schemes that are set up outside of the UK, but still they are registered with the UK tax authorities, HMRC. These schemes operate in a very similar way to UK schemes, but are denominated in euros. A self-invested personal pension, or a SIPP, is similar to other pensions that it holds investments until you retire and start to draw a retirement income. The main difference between a SIPP and other pension vehicles such as a QROPS is that you have greater control and flexibility over the investments in the scheme, hence self-invested personal pension. You can either manage these investments yourself or designate an investment manager to oversee your fund. SIPPs can be suitable for UK and EU tax residents alike. The greater levels of control and freedom afforded to you by SIPPs make them an ideal option for people who want to be more actively involved in the management of their assets. International SIPPs, similar to QROPS, can be denominated in euros for convenience and to minimize currency risk. I'm going to talk about that now. That's actually one of the key differences between UK and expat pensions, whether they are held in the UK in pounds sterling or in the EU in euros. Of course, if you are an expat in Europe, holding a pension in pounds sterling means that the value of your pension goes up and down according to currency fluctuations. So for those in retirement, having an inconsistent level of earnings in this way can be problematic. If the pound strengthens, then the purchase power that you have with your pension increases. And if the pound weakens, then it decreases. So having that instability of buying power can be a little bit disconcerting for a lot of people looking for that stability in retirement. Withdrawing a UK pension whilst living abroad can also create an administrative headache, as you may be charged UK income tax, which would need to be reclaimed via a tax credit in your country of residence, Spain, Portugal, France, wherever it is that you've chosen to retire. That said, in most cases, it is possible to have your pension income paid gross, so gross of tax before you've paid tax, and this way you can avoid an administrative headache. Okay, so we've already seen that transferring into a European pension for a life in Europe provides a steadier income by eliminating currency risk. We've also discussed how it can reduce your time spent on administration by taking your pension out of the UK tax system. These are clear benefits for someone looking to get started in a new life in the EU. There are other reasons, however, to consider a pension transfer. I'll go into that on this slide. So firstly, pension consolidation, putting everything into one place. It is quite normal, and you might find yourself in this circumstance yourself. It's quite normal for someone to have multiple pension funds by the time that they retire, usually as a result of changing employers during their career. It's quite rare these days that we stay at one employer for our entire career. Therefore, keeping track of these funds can often be time-consuming, costly, or inefficient. If this is the case for you, then consolidating your funds into one pension scheme, provided that it's suitable for your residency status, could be a sensible decision. You can also avoid UK lifetime allowance charges by transferring. So if you're transferring into a QROPS or an international SIPP, the lifetime allowance in the UK, which sits currently at just over £1 million sterling, ceases to apply after the transfer. So this is particularly interesting for UK expats that are looking to continue contributions into a pension fund whilst in the EU, or if the pension fund doesn't allow for continued contributions, where they anticipate that the value of that pension fund may exceed that lifetime allowance of just over £1 million sterling over the course of their life, up to the point where they claim the retirement income. And then finally, reduction of insolvency risk. So you might not know this, and it might be a little bit alarming for you, but over half of UK defined benefit schemes are currently underfunded. Yes, over half. And therefore, this represents a significant insolvency risk to the members of such defined benefit schemes. Now, under something known as the Pension Protection Fund, or PPF, you may not have 100% of your benefits guaranteed in the event of scheme failure. So transferring out of these underfunded schemes could therefore be attractive in some cases and is worth bearing in mind. It's also important to point out that a decision to transfer out of your UK pension may not be suitable for you. This is especially the case for defined benefit pensions. You should consider the following drawbacks before transferring out of a DB scheme. Number one, the sacrifice of guaranteed benefits. So the benefits of a DB scheme are payable for life, as I hinted at earlier. When transferring out of such schemes, you lose these guaranteed payments. And after transfer, the amount of funds at your disposal are capped to the value of the fund. So again, it can run out before you pass away. Number two, loss of pension protection fund, or PPF protection. Again, I hinted at this on the previous slide, but in the event of a DB scheme insolvency, the PPF guarantees the payment schedule up to certain thresholds that may not, however, be 100%. Transferring out of a DB scheme takes you out of this layer of protection. So whilst it might not be 100% guaranteed, it is still a layer of protection that, provides a value and should be considered before transferring out of a DB scheme. Number three, administration costs. So defined benefit schemes pay a determined amount regardless of their running costs. By transferring out, you may become exposed to administration and management costs of running a defined contribution scheme. Ongoing management fees to pay for a pension wrapper or an investment advisor, that kind of thing. And number 4, investment risk. As your fund performance is subject to investment, as your pension fund performance is subject to the performance of that investment, the fund value will rise or fall in line with your underlying investment portfolio. This is not the case with the fixed benefits that come from a DB scheme. So if investment risk is a concern for you and you have a particularly conservative attitude to risk, maybe it's better to leave your DB pension where it is. And just a final note on this, UK public sector pension schemes such as the NHS, teachers, policemen, firemen, etc. are not eligible for transfer. That's just a stipulation in these individual schemes. And some pensions that are already in payment may also be ineligible due to the fact you're already drawing the benefit. Seek advice if you're unsure, and I personally would recommend anything to do with defined benefit schemes. Do seek professional, independent advice before proceeding with anything, because the stakes are quite high when we talk about DB schemes. Okay, additional tax considerations. Now, the overseas transfer charge is something that's worth mentioning. The overseas transfer charge, also known as the OTC, yet another acronym for you. It was introduced in March 2017 by the UK government with the aim of discouraging UK taxpayers from transferring their pension funds into the more attractive overseas schemes. The charge is incurred at the moment of transfer and comes in at an eye-wateringly punitive 25%. This means that you would lose a quarter of your pension fund simply by transferring it abroad. Fortunately, however, the OTC does not apply when transferring to schemes within the EU or European Economic Area, provided that you are also a resident of the EU or the European Economic Area. Therefore, at the time of giving this presentation, a pension transfer to Spain, to France, to Portugal, to Malta, or other European country does not incur this charge. However, it is still currently unclear how this situation will evolve in the aftermath of Brexit. You may therefore wish to delay taking any decision regarding a pension transfer until such a time as the new regulations are clarified. Currently, just to let you know, in our line of business, we are proceeding business as usual with pension transfers, and no overseas transfer charge is applicable. So we're still operating business as usual with no problems. But that is consideration to bear in mind if this is something that's on your radar. Please note that it is important that you remain resident within the European Union or European Economic Area for a minimum of 5 years from the date of the transfer to remain outside the scope of the overseas transfer charge. If you do not, you may receive a nasty surprise from the tax authorities in the future. So if you cannot commit to such a timeline, again, you may be better off delaying a transfer decision. You may also become liable to UK income tax on benefits that you receive while overseas if you return within that 5-year time frame, which can lead to a significant tax liability. So make sure that if you transfer your pension, you're doing it in the context of a move overseas for the longer term. And a quick note on tax planning. When resident in the EU, holding money in a pension fund is it's very tax efficient. However, when taking benefits, there can be certain taxation pitfalls that can lead to unnecessary costs, particularly in the case of expats. If you are an EU tax resident or about to become so, then you should seek advice on your options before taking any decision. It's generally best to seek advice as early as possible in the process, and that's ideally before moving overseas, to keep all of the options open to you and maximize your tax planning opportunities. As to do so a little bit later on in the process may tie the hands of your advisor when you're looking to actually take a decision and optimize your position. Okay, so in a whistle stop, those are the essential bases that you should be aware of as a UK expat in the EU. This is a little bit of a taster, a little bit of an introduction session to try and get not too bogged down with the technicals. But if you have any questions, now would be the time to go into it. We have other resources available if you want to dive in, and there are other concepts that we could be talking about, other types of pension vehicles, but what we've covered today really is the fundamentals and is about 95% of what you really need to know as an expat, and the other 5% are really minor technical details that an advisor will point out in the context of your direct work with him or her. So to wrap up, we will now move on to some questions if we have any coming in. So feel free to drop any questions in the Q&A box and we can have a discussion on that now. I can see that we don't have too many questions coming in. This is either that I've done an excellent job of explaining, which I highly doubt, knowing myself. I usually explain things twice. Or there are no questions that are coming up at the minute, or people are shy. Well, in any case, guys, you have my contact information here. So it's jonathan.ralph@holbornassets.com is the email to get in touch. And you also have my Spanish mobile number there, which is +34 644 483608. I prefer an email. It just means that I can come back to you in a more relaxed and detailed manner, and you can have a record of that. When you're looking to assess your situation, these things tend to take a little bit of time when we look at pension transfers. It's a considered decision. So yeah, feel free to get in touch with anything that you have. I see that there's no more questions coming in which case we can wrap up for today. So thank you for your time. Thank you for your attention. I hope this was useful and informative, and I wish you all the very best in your life in the European Union. So thank you very much, and goodbye from me. Have a great day.